Let's talk bonds, people. What are they? Simply put, bonds are loans. You become the lender. Governments, corporations, even cities can be the borrower. They need money for various reasons, building bridges, funding projects, you name it. When you buy a bond, you're essentially lending them money. It's an IOU, a promise to pay you back. You're not buying a piece of the company like you would with a stock. You're loaning them money with the expectation of getting it back, plus some. Bonds come in different shapes and sizes. You've got your US government bonds, considered very safe. Corporate bonds are issued by companies, and they carry a bit more risk. Municipal bonds are from states and cities. Each has its own risk and reward profile. The key takeaway here is this: bonds are debt. They're a way for entities to raise capital and for you, the investor, to potentially earn a steady income. But remember, every investment has risks. Now, let's break down how bonds work. Imagine you buy a bond for $1,000. This is your principal. The bond has a maturity date, let's say 10 years. That's when you get your $1,000 back. During those 10 years, the bond pays you interest, also known as the coupon rate. Let's say it's 5%. You'll receive $50 per year for 10 years. That's your reward for lending your money. But here's the thing: bond prices can fluctuate in the market. If interest rates rise, your existing bond with its 5% coupon might seem less attractive to new investors. They can get a better return elsewhere. So the price of your bond might drop if you wanted to sell it before maturity. Conversely, if interest rates fall, your bond with its fixed 5% rate looks pretty sweet. Its market value might increase. Remember though, you only get the face value back at maturity. So, why are we talking about bonds in 2025? Well, the financial landscape is shifting. Interest rates are higher than they've been in years. The stock market is volatile. There's talk of a potential recession. People are nervous. Bonds, particularly government bonds, are often seen as a safe haven during uncertain times. They offer stability and predictable income. When the stock market is bouncing around like a rubber ball, bonds can feel like a warm blanket. That doesn't mean bonds are risk-free, because they're not. But they can provide some diversification and potentially cushion your portfolio against losses in other areas. Section 4: Bond risks, not without their pitfalls. Now let's talk about the risks associated with bonds. Knowledge is power, people. First up, interest rate risk. As we discussed earlier, if interest rates rise, the value of your existing bonds can fall. Then there's inflation risk. Inflation erodes the purchasing power of your money over time. If inflation is high, your fixed bond payments won't buy as much in the future. And we can't forget about default risk. This is the risk that the issuer of the bond won't be able to pay you back. It's more common with corporate bonds, particularly from companies with shaky financials. Understanding these risks is crucial before investing in bonds. Don't just blindly jump in because someone said they're safe. Do your homework. Section 5: Taking the bond plunge, your investment options. Now that you know the basics, how do you actually invest in bonds? You have options, people. You can buy individual bonds directly from the government or through a broker. This gives you more control over your investments. Another option is bond ETFs, or exchange-traded funds, or mutual funds. These are baskets of bonds that track a particular index or sector. They offer instant diversification. And of course, there are corporate bonds, issued by companies. These typically offer higher interest rates, but also come with higher risks. The best approach depends on your individual financial goals, risk tolerance, and time horizon. Talk to a financial advisor to determine what's right for you. Section 6: Should you invest in bonds now? The million-dollar question. Is a good time to invest in bonds? The answer, as always, is, it depends. On the one hand, interest rates are relatively high, which means you can lock in some decent yields. On the other hand, if interest rates continue to rise, you might be better off waiting for a better entry point. The stock market is volatile, and there are whispers of a recession. Bonds can offer stability and potentially outperform stocks in a downturn. Ultimately, the decision is yours. Consider your financial situation, your risk tolerance, and your investment goals. Diversification is key. Don't put all your eggs in one basket. And remember, never invest money you can't afford to lose.